Hello and welcome to Find Your Freedom, a podcast dedicated to helping you truly find freedom in all aspects of life. Join your hosts and their expert guests as they share practical tips and strategies for finding more freedom in your life. It's time to take control of your life and create the future you want. Let's find your freedom. Here are your hosts, Lenny the Boss and Omid Rad Investor.
We are back with another amazing episode of Find Your Freedom, and you're going to get the ultimate value out of this podcast today. But before we go there, this podcast is brought to you by Wealth Builders Mortgage Group. I'm going to tell you, these individuals over there are awesome for your needs when you are looking to buy a home personally, get an investment property, short-term rental, long-term rental, whatever you need. They are the individuals to go to. And we're saying this because Omid used them. I use them as well. They're 100% great. So Wealth Builders Mortgage Group is 100% where you need to be. So this time of the season, we all know we get a little nervous. We get a little antsy because it's all about taxes and how much we going to owe, how much we going to save, what can we save on, are we doing the right things, where our money is supposed to be, are we dealing with a CPA or are we dealing with our aunt who like to do taxes for us, right? And today is going to clear that up. We have a expert, which is a great guy. He's been in the field, in the industry for many years. He's also an investor himself, which make him that much more powerful. I mean, look, not to brag, but the guy went up against the king, which is the IRS, with his clients. And I got to say, the results has been very, very, very positive for his clients. And he can speak to that. But without further ado, we're going to bring in Ryan. Ryan, how are you feeling, man?
Amazing. Thanks for having me on the show today.
Awesome. Hey, we just want to really get into this. So if you could, man, just share a little more about your background.
Yeah, my name is Ryan. I'm a real estate CPA and investor as well. I started off my career working, I have an accounting and finance degree, so that's my background. Pretty quickly working in the accounting field, I realized that I was helping people who are already super rich and wealthy become even more rich and wealthy. And I decided that not that I wanted to help the everyday person, but I wanted to help the person and their family that was going to change their family tree. So that's why I had left Deloitte, which was a consulting firm I was working at, to work full time with real estate investors. So we help real estate investors build wealth using the tax code. We also help them file their tax returns as well. And then, over this 3-4 year journey, I've come to learn a lot about the space in terms of not only tax strategies, but also asset protection, and then even thinking one step ahead and setting yourself up for the next deal. Because I would say the number one mistake that investors make that prevents them from scaling is they max out their debt to income way too quick. And we help our clients make sure that they look good on paper. Save as much money in taxes as possible to the IRS, but then look really good to lenders so that they can borrow money to buy another house.
And I can actually attest to that. So Ryan's been an incredible partner. He and I have had a ton of conversations about how mortgage lending works, and something that's always a great mark of a good CPA when it comes to this short-term rental space or any real estate investing space is a CPA that's interested to know, hey, how does what we do here affect lendability and debt to income ratio? So I can definitely attest that Ryan's excellent when it comes to that collaboration.
So can I jump into that real quickly? So that's actually really interesting to me, because I think a lot of people, maybe a newer investor, they're just looking at the first deal, and they're not looking further past like that first deal. So like if I'm a newer investor, what are some precautions I can take, or some preparation kind of in advance, so that maybe I can look further past like the first or even second deal?
I could go ahead. So I always use the analogy of when I go out to bars with my friends, I'm the most annoying person because I like to shoot pool, like bar pool, shooting pool. And I'm annoying because I take so long to shoot. And my friends are like, that's an easy shot. Why don't you just shoot it? I go, I'm not worried about the shot. I'm worried about where my cue ball is going to end up at after I make the shot. And not enough investors are worrying about where their debt to income is or their financial situation looks like after they do that deal. I'll give you some tips, and to me, it really depends on what I call what season you're in as an investor. If you're just getting started and you need as much income as possible to show to banks, you don't really want to write off everything under the sun. And sometimes you have to like earn your dues or pay your dues, so to speak, for the first couple of years. But once you're a seasoned investor, maybe you have a high W-2, you already have 3 or 4 properties, then maybe you can write off everything under the sun because you're still going to be able to qualify for that next mortgage. So to me, it really depends on what stage of the game you're at. But if we're talking about a beginner investor, I'm making sure that I understand what my debt to income is before I even buy a property. What does it look like after? Because that's the thing with a lot of these calculators too, is they're calculating your debt to income in order to buy the property, but it's not really telling you, well, how do you look afterwards? Like, how long do you have to wait until you can buy another property?
Hey, Ryan, on that note, not to throw you off of your game, but we actually have a cool new mortgage product that instead of using, it's not a fanny, it's a non-QM product, but instead of using tax returns for rental income, for short-term rentals, we can use 80% of a 12-month gross income look back.
Oh.
So $100,000 gross, we can automatically use 80,000 divided by 12. So it's pretty cool. So for those that are struggling with DTI, just throwing that out there. But,
and I think too, that's why the timing of when you go live is important, because you obviously want to have a plan, especially if you're in a like a Florida market, I think is seasonal at times. If you miss the ball and you get live too late, you're going to miss out on 60-70% of the total bookings. But not only that when it comes to timing, but also like when you're showing that property on your tax return, because if you bought a property in the fall and you didn't get live until, let's say, November or December or the next year, well, that property is going to sit on your overall debt picture, even though you don't have any income tax return wise in order to offset it. So I try to have our clients and investors and students, if you want to call them, always thinking 1 or 2 steps ahead and how they can achieve what they want to, save money on taxes, but then also qualify for the next deal.
It's pretty interesting. I love that pool analogy that you use.
Yeah.
I was watching the football game last night over my sisters, and they have a pool table, and this guy was taking long to shoot the shot. And truth be told is I'm no great pool guy. I just like to get out there, kick people butt, and keep it moving, right? You hear me kick people butt, right? but maybe that's exactly what they were doing, forecasting where the ball was going to go. That's probably why I got my butt kicked last night, but as a new investor, you mentioned about buying property and DTI and when to buy a property. How often should a new investor come and meet with a CPA so they can, once again, know what they're doing, kind of say, hey, after I hit this ball, buy this property, what am I going to look like, where my cue ball is going to go? How often should they meet a year with a CPA to know those things?
It'll first depend on what they have going on besides the property, like whether they're a business owner, whether regulating cash flow is super important to them, especially if they're a business owner. They might have 1 month, like maybe they make 300 grand out the year, but they're making most of that money in 3 months rather than the entire year. So if you have irregular cash flows in your business, sometimes you're going to want to meet with your CPA quarterly. If you're just a steady W-2 and you're kind of getting paid the same amount, then that conversation around your debt to income, you're probably only going to have 2 or 3 times a year, or after you buy a property, hopefully before you buy the property, so then where you're going to end up at after that acquisition.
Got it.
And one more thing about timing too that I wanted to bring up. You can, in a legal and ethical way, manage your tax return filings. So I'll just give you an example. Let's say, so on a conventional loan, because I just went through this process early last year, they were going to take 2 out of my last 3 business returns in order to help qualify my self-employment income for tax purposes. Well, this was April or May, and I had not filed my 2023 tax return. So I now see that return. I made a lot more money in 2023 than I did 2021, 2022. So I wanted to file that return as quick as possible so they would use that to help qualify me. But flip it on its head. Like, let's say 2024 was a bad year for you, right? You didn't make as much money as you did compared to 2022 and 2023. Like, you should try as hard as possible, legally and ethical, to extend your 2024 filing, have your lender use your 2022 and 2023 numbers to help you qualify for the loan. So there's some legal gamesmanship that you can do with your tax returns in order to qualify for a loan. Yeah.
Yeah, as long we can use the most recently filed return until the October final deadline, as long as you have an extension. So absolutely, or longer. Some people have natural disaster extensions even into the next year. So, yep, absolutely.
So can we get a little bit into like write-offs and just like understanding write-offs? I feel like I would say like the average investor, maybe a newer investor, is still kind of in the process of learning like what can you write off, when should you write it off, how I know with short-term rentals, it appears like the bonus depreciation and that seems to be like cost segregation seems to be like a popular topic. Like when is it appropriate to do it and when is it maybe not? Maybe if you can kind of like get into that a little bit and like how that maybe helps with like compounding money and the power of compounding money.
Yeah, I'll start with write-offs. So first, it's important to make sure you understand what you can write off that the lender actually adds back to your income, and then what you can write off and save money on taxes, but then the lender counts it against you for purposes of qualifying for a loan, right? So you have your expenses like property taxes, insurance, mortgage interest, depreciation, HOA fees that the lender will add back. But what they're not going to add back are repairs and maintenance expenses, supplies, cleaning. So these are, because they're considered cost of doing business, and it kind of impacts your bottom line. The lender's not going to add those back. I use this example.
Right, let me just right. When you say add back, what does that actually mean? Add back.
Thank you for asking. So I send out this email maybe once every 3 months, and the subject head of the email is, your tax return is the only place you want to be poor. Okay. To your friends, to your family, sometimes to your lender, you want to have a lot of money, right?
Your wife, your husband.
To the IRS, you want to have nothing and goose egg, right? And in real estate, it's the only asset class that you actually can achieve that. Because if you have rental properties and you're writing off depreciation, you can show $0 on your tax return for taxable income, but then for lending purposes, they let you add it all back. So like I've had clients make $300,000, $400,000, $500,000 a year cash flow. Their tax return says $0, but then when they go to a bank, the bank says, "Oh no, you made $400,000 or $500,000, and here's the approval for the next loan." Yes, yeah. Okay. So your tax return is the only place you want to be poor. That's how I phrase it.
I like
because it's a question we get all the time. One of the things we do when we finish people's tax returns is we send them about an 8 to 10 minute video that recaps the strategies we did, how much money they saved, any recommendations we might have, and then we also mention something about a lending. Because one of the questions we get is, well, doesn't that mean that I made $0? Like, is the bank going to not give me a loan? And I go, no, look, they're going to add back all these things. So you really actually made $150,000 or $200,000, even though you paid taxes on nothing.
Okay. All right. So say CPA should clearly define what can be added back versus what can't, so they have an idea of what to write off, and what not to write off. That's smart.
And I tell my realtor clients this all the time, because real estate agents are different. So they want to go and write off, a truck or a car or whatever for their business, but those things are not added back to their income. So you have to be really careful. So a realtor making 150, 160 grand and goes and buys a Porsche, even though that Porsche is depreciated, it's not seen the same as rental depreciation. So you got to be careful, and you got to know what you can actually add back and then what counts against you for lending purposes.
I have a question. When the auto depreciation is written off, what does it show up as? Like on Schedule C?
It shows up on Schedule C. There's a line called depreciation.
Okay.
I think it's line 17, if I'm not
Okay.
mistaken.
That can be added back.
Okay. Not that I have it memorized or anything, but
No. Yeah. And how about if they have a business return, an S corp or partnership? Does it show up on that same depreciation line?
14, I think.
Okay.
I could be wrong.
And I think
So
you're right.
question
Yeah.
on that. So whether you purchase it or a lease, what's the difference?
There you go.
Or you're even making it. So like, let's say I want to buy a car this year under my business,
A G-Wagon.
hypothetically, but really want to do that, and it meets the criteria of like the weight. What is more like? What's the differences?
To me, I guess one thing it depends on is the overall purchase price amount. So if the vehicle costs more than 40 grand, you're most likely going to be better off financing it and writing it off in that first year or first couple of years. When you lease, you just write off the lease payments, which can in theory be higher than the depreciation you're getting, but you're getting that slowly over the course of the lease, rather than when you're buying a vehicle and it meets qualifications, you're taking the majority of that in the first couple of years. I'm trying to think. Obviously, the lease, you don't really have any equity in it compared to buying it and financing it. Most people end up, for business purposes and what we do, most people end up financing the vehicle because they can put, oftentimes the tax savings for buying a vehicle are more than the amount of money that you had to put down. So if I bought a $60,000 vehicle and I'm in a 30% tax bracket, I saved $18,000, but I only had to put probably $12,000 or $13,000 down on the vehicle, and then I just have to make whatever the payment is.
So is the down payment a write-off as well?
So you're not writing off the down payment. You're writing off based on the purchase price of the vehicle. So
this is good stuff because because no, it makes a whole lot of sense because a lot of these car dealerships, especially when you're leasing vehicles, they want you to put a large amount of money down. So it makes no sense to put that large amount of money down because the higher the payment, you're just going to write it off anyway. Versus, people usually put a certain amount of money down because they want a certain payment amount.
Yeah.
But, help me out here, Ryan. Does it make sense to sit there and say, hey, take the $900 payment or put $5,000 down? This math might not math out, but put $5,000 down and take the $550 payment.
To me, so each vehicle, you could look this up, but each type of make and model has its own depreciation sort of curve in terms of like how quickly that specific car loses value. And so if there's some that are like, they're just going to lose a ton of value immediately anyway, maybe you do lease it because it's your equity. You're going to be upside down within a year on the loan. Like you're going to owe 40 grand, but the vehicle's only going to be worth 30. So it's actually negative net worth to you. So if it's a vehicle that's like rapidly going to depreciate anyway, I'd probably just lease that one. If it's going to hold its weight in terms of not depreciate, then maybe I would finance it and put a loan on it. Does that make sense?
So a question on that with like the loan, like let's say you qualify under your name, but what about like under the business? Does it matter if it's under your name or under your like S corp or even like an LLC that where you own a property? Like, does it matter or can you interchange them?
So most people want to buy their vehicles in their personal name because they'll get way cheaper insurance than buying it as a commercial vehicle. And so then you have to draft an agreement between you as a person and your business entity to allow for the use of the vehicle. Now, as far as insurance goes on that, if you get in an accident, I'm not a lawyer. I'm definitely not your lawyer. But most people will buy it in their personal name and still use it in the business because they'll get cheaper, they'll get way better terms and they'll get better interest rates. It's just like buying or better insurance. It's just like buying a house in your personal name versus buying it in an LLC or using, a non-QM mortgage. Or you're always going to get the, I guess, quickest, cheapest, easiest rates in your personal name than business most cases. I feel like I'm Billy Mays. The quickest, cheapest, easiest way to.
That's hilarious.
So one thing I see a lot of when we're talking about things to write off, like you're talking about, depends on when you purchase your short-term rental in terms of how much income you can show. And I've always wondered this because I advise my clients on the mortgage side to go back and just ask their CPA if there's any way, because a lot of times people will purchase a lot of furnishings, right? And that can be 20, 30, 40, 50,000. And so my question, because obviously we can't add that back in. So my question is, can that be depreciated instead? Or is there another way to show that? Because even if they bought it 7-8 months in, if they had a very large amount for furnishings or along those lines, it can really impact their income. So any suggestions on how that can be best shown to also be beneficial for lending?
So it depends on what stage they're in of their investing, right? So somebody who needs to show as much income as possible, when they buy the furniture, they have to depreciate the furniture on their tax return. So that means instead of it showing up on that as a supplies or some type of expense, it shows up as depreciation. The con with that, though, is of the depreciation recapture someday down the road when they sell the property. They have to recapture some amount of the furniture back. But it'll still save them money on taxes, and the lender will add back that depreciation, right? Now, if they're further along the way and they're not too worried about having to show income in order to qualify for tax purposes, well, then they just expense the furniture on their tax return. And then that way they save money on taxes. And then when you expense things, you don't have to recapture it sometime down the road. So that's why I say it depends on what season you're in, because our clients who, let's say, have a good W-2 income and they already have 6 or 7 properties, they're just expensing everything. If you're newer and you want to save money in taxes, but you also want to qualify for loans, you got to depreciate everything.
That makes sense.
Wow. All right,
yeah,
man.
Mind blown. Wow. I know.
Yeah,
Right?
Like this is you gonna have to say that again, man. Like, hold on. Let's rewind this story right here for a little bit and let's stay in this pocket. So I was talking to a guy and he was like, oh, I'm going to enter to this coaching program for $15,000 because I have to give this to the IRS anyway. And I just rather invest it into myself than give it to the IRS. So, I understood what he was saying, but can you kind of break that down and break it down in the sense of when a person should be looking at it that way of saying, hey, I got to write a check to the IRS and it's going to be a big one. Right. And yeah, I got some properties and all this good stuff, but I still got to write a check to these guys, but I need to, what can I do to better myself, better my business that you can use to, rather than send that check, but it benefits you on your tax returns. Does that make sense?
Yeah. I mean, the first thing you're going to want to look at is what your tax rate is to start. So if let's say your federal tax rate, and then if you live in a state that has income tax, like I do, sadly, here in Illinois. So let's say my combined tax rate is 40% between federal and state. So the way that you think about that is that 15 grand that you're going to invest into a coaching program. It's not like you're saving 15 grand in taxes. You're saving 15 grand in taxes multiplied by the 40%, right? So he's going to save, I guess if my math's good, he's going to save $6,000, right? The way you could see your tax rate is almost like a coupon. So JCPenney, Sears, Kohl's, when you spend that 15 grand, the government's subsidizing 40% of it, because now you don't have to pay that 40% in taxes. Now here's the thing. The government cannot tax your unrealized gains up here. Okay. So if I pay money to learn how to go and make $100,000 a year or $200,000 a year, the government can't tax that knowledge until I actually do it on paper. And if you, this is further down the road, but if you design your businesses in a way to where they're not making money on paper, and in fact, they actually make the most amount of money when you exit, like when you sell the business,
Yeah.
then you're turning those gains that would have been ordinary and taxed at a 40% tax rate and turning them into capital gains, which are only taxed at 15 or 20% when you exit, like when you sell the property or you sell the business. So I'm going down that road, but I'm a really big fan of investing in education and mentorship and coaching, because obviously, number one, I get to write it off on my taxes. And to your point, if you were going to give that to Uncle Sam and you needed to spend money on something, but I'm a big fan of investing in myself. If I knew what I knew now, like I actually would spend way more money on investing in the SME 500 rather than the S&P 500.
S&P 500, nice.
So
that's the first time I ever heard that. That's funny.
Yeah, it's a good one. But I'm just trying to make that a point. If you spend money to learn how to go and make more money, they can't, like the government cannot tax you until you actually realize or show that up on paper, right? And if you're investing to learn about real estate and you're going to get more tax deductions anyway, it's likely that you won't even have to pay taxes on the money anyway. It's funny. Do you guys, that Vince McMahon meme where he's like 4 different pictures of him, and like each one gets a little bit more funnier or aggressive after each one?
Yep.
Well, we'll have to cut to it, but there's one where it's like learning to save money on taxes, and then paying Ryan to learn to save money on taxes, and it's like deducting the payment that you learned how to save money on taxes so you could save more in taxes. And it's funny because people that invest with us, they get to write off the payment to their CPA, which is a tax deduction in itself. And then they're going to learn how to go save more in taxes. So it's like this incestuous cycle of just saving more money on taxes, which is kind of funny.
No,
By the way, I signed up with you this year, Ryan, so I'm expecting big things.
I'm excited.
Uh-oh.
So what are some overlooked easy deductions like write-offs that just people just seem to kind of overlook, or investors, or even like let's say you take on a new client and you're like, oh, the CPA they didn't do this, and this for you previously.
So the biggest thing we're seeing right now is clients who it is their first or second property and they don't have like an actual separate bank account for the property, like they're commingling or they're buying stuff out of their personal name. So now most like utilities like insurance, water bills, gas bills, electric, like we're picking up all those, but it's you buy a house and you have all these kind of one-time things that you need to spend money on, and if people don't have it in a separate bank account, like they forget that they put money into the property. Like they forgot about this, $2,200 bill over here, or they forgot about this. One of the things I see in the Smokies all the time is people don't write off pest control fees. And I'm like, I know you guys got bugs and bears over there. So where is it at? I know it's, and like, it may only be like $800 for the year or something, but it's still like those types of things add up. And I think that's why it's important to have, a CPA that deals with real estate, because nobody else is going to know that about those properties, or like in colder areas of Florida, like you might have a gas heater as opposed to electric if you have a big enough pool or hot tub. Like, whereas a CPA that doesn't deal with a lot of real estate, they're not going to know that type of stuff. Trying to think, when investors own a lot of properties that are in states that have income tax, there's other elections that you can make on your tax return to get basically your property taxed at the lower rate. So like if you live in California, you have a 13% top bracket, but you might own a property that's in Alabama that only has a 5% tax rate. Well, if you don't do anything, California wants to charge you 13% on the property that is in Alabama when you'd rather pay the tax to Alabama and keep your 8% difference. Does that make sense?
Dang.
Totally.
Yeah.
Totally. Yes. Ryan,
Yeah.
I have a good story for you about pest control in Tennessee.
Okay.
So, yeah, it definitely got written off on our taxes because this was when my husband first kind of started letting him take over management so I could focus on mortgage. I don't know what he did or who he was working with, but for our 8 properties in the Smokies, somehow this pest control guy got $24,000 out of us for 1 year of pest control. I was like, what are you, as soon as I found out like the amount he was spending out, I was like, what are you doing? What is this guy doing for us? So he got fired really quickly after that. Not my husband, the pest control guy. Can't fire my husband. So yeah. So now we've got some, it'll be like, I don't know, $5,000 for all the properties for the year now. But yeah, that was a big expense.
Well, and it's good to have somebody that knows, I guess, the industry metrics too. So like when I teach, at the last STR Wealth Conference, I taught underwriting, like pro forma underwriting, kind of just, hey, if you buy a property for this amount of money, well, it needs to do about XYZ in revenue. And if you can do XYZ in revenue, well, your operating expenses are going to be a certain percentage of that. And then your debt service, which is your principal and interest, should be like a certain percentage of that. And just seeing like trends and patterns in the STR industry, like we can tell our clients like, hey, you probably shouldn't be paying $3,000 a month or $3,000 per property on pest control. Like
Yeah.
there's it's a double check with your accountant. And I may or may not have a list of all the properties that our clients have and know which areas make more money than others, along with the associated expenses with them too. But that's just something that you get with working with us that you wouldn't get with a normal accountant, I would say.
That's some good stuff, and I want to stay right there for a little bit. So help us out. Now, a lot of people get accountants because we just unknown of this 70,000 page textbook tax codes. You guys are the experts. You guys, girls, know exactly what to do. Now, you get with your tax individual, they do your taxes. They've probably been doing your taxes for years. You feel comfortable with the process, easy peasy. Are there anything that you can share? Maybe 5 tips or 5 things to look out for to even know if they're doing a good job for you or not?
One of the things I always mention, because people who are in the short-term rental industry will ask, like, what are some of the questions that I know if a CPA is good or not? And it's floating around in one of the Facebook groups, but I took maybe half an hour to respond with all the questions that I would ask. But, hey, what markets are your clients in? If they can't list off Gulf Shore, Seaverville, Big Bear, like if they can't list off all the short-term rental markets, probably not a good fit. I also have a list I don't mind providing to the group, the podcast listeners, that has like basically every single document that you need in order to file your tax return. And if they don't ask for those documents, it's probably not a good sign that they are going to be good with your information, because if they're not asking for those documents, well, then guess what? Stuff goes missed if they don't ask for certain documents. And if you don't know to upload it or to tell them, then they might miss something like that. So I don't mind sharing that list with you guys. But other questions, I would say, yeah, what markets do they have clients in? Do they invest in real estate themselves? Are they familiar with the different types of rules, like real estate professional status and short-term rental loophole? Some of the like jargon that gets thrown around. Those are great questions to ask. I think the most important one is to ask them if they invest in real estate themselves too. And what's interesting about my firm is pretty much all my employees also own rental properties too. Everywhere from like my accountants that work for me, as well as my salespeople, even own rental properties too. So it's pretty cool.
Is that like a requirement?
No, but it's just I don't know if it's it's just how they originally found my company or how I found them, but it's definitely something good to have, because sometimes you feel it's tough. I mean, I get a lot of people come to me and they're like, well, I'm trying to communicate with my accountant, but they're twice my age and they don't know our language, and they like mansplain things to me, or they can't make it, like, Ryan, you make it so easy for me to understand, like, nobody else can do that. So.
No, that's I've always said that about you. I think you break it down into layman's terms, so it's like you dumb it down. I always like the Cliff Notes version of everything, and I feel like you're like the best in terms of the accounting space to do that and explain it in a very simple way. So appreciate that. I guess one more question is, I'm an investor. Like, do I save money or do I do the big write off and then use that to invest into something? So what are like the pros and cons? Like, let's say I want to buy something. Do I stretch out the depreciation, or do I do it all up front and then use that maybe write off, and maybe I'll get some tax
Yeah,
savings and put that into a down payment?
it's a very advanced understanding of it, but I want to simplify it to I'm always looking at what your tax rate is now compared to where we think it's going to be. So kind of like, Wayne Gretzky, I'm not skating to where the puck's at, but where it's going to be. So I'm trying to think of, okay, well, here's your situation now. You have a dual income household. You're making 400 grand, 500 grand combined, or maybe you're making 300 grand a year. You have 3 kids. The oldest one's going to be in college in 2 years. You got 2 more that you need to go through college. And here's what the plan looks like at your job. Here's what you already have in 401ks, cash, stocks. Here's what you have in your primary home. Because that's one of the things that we do for new clients is we get them to fill out a net worth statement, which kind of allows us to give them better advice about these questions, because I need to know the background to your story before I can give you like sound tax advice. But the way that it works, the patterns that I've noticed amongst my clients is because they're taking their active income from their W-2 or their business and they're shifting it into real estate, odds are they will be in a lower tax bracket in the future. Now, it's not guaranteed that our tax rates are going to go down in the future, but if you go from, like, these clients are wonderful. I think Parker's worked with them before, but they were both tech employees, clearing probably $500,000 in just W-2 income when I started working with them. And we basically work with them to liquidate one of their properties that was underperforming and then invest it in the short-term rentals while saving money on taxes at the same time. And fast forward 3 years later of working with them, they make the same amount of money that they did, the 500 grand that they were making when they were both W-2s. Now one of them fully quit their job, the other one just works part-time, and they actually make just about the same amount of money in their rental properties than they did when they're W-2, and they're paying like a third amount in taxes that they were before.
That's
because it's not about how much money you make; it's how you make it. It's a vehicle, shape, of form. So if you're a doctor making $500,000 W-2, you're screwed. If you're making 250 grand W-2 and 250 grand in real estate, well, that's a whole different conversation, because it all depends on how much write-offs and deductions you have on the real estate, right? So, but I'm always looking at what your tax rate is now. If it's 32, 35%, then we want to take and accelerate that depreciation now, and we want to write off everything under the sun. Take those tax savings, reinvest them, not spend everything, but reinvest that into the future, because when you do have to sell the property or you do have to start paying taxes, it's going to be at a lower tax rate, 12, 22%, as opposed to 32 or 35%. Seldomly do I see the opposite happen, where the worst thing that can happen is, let's say you're not working at all and you somehow magically happen to buy 2 or 3 properties that year. Well, you don't want to accelerate the depreciation that year because you don't have anything to write it off against. You'd be better off stretching it out and waiting until you have a year where you're back and working full time again, or your income's back up. Does that make sense?
Yeah. No,
Yeah.
that's complex, but simplified.
Yeah.
Mm-hmm. And also too, every single time I've done the analysis, the math always came out ahead by taking the depreciation now when you're in a high bracket and then paying it back when you're in a low bracket. So for instance, like, even if you bought a property in year 1 and you sold it in year 5, you're likely paying less in taxes because of the depreciation over those 5 years of your furniture and equipment. the appreciation on the building, you're going to make enough in appreciation on the building in order to cover the tax bill. And remember, the tax rate's going to be lower too, because you probably borrowed the money at 32%. And if you've done a good job of shifting your income from active to passive over those last 5 years, well, now your tax rate's only going to be 12 or 22%. So you're always going to come out ahead if you have a long enough time horizon, because it's all based on time value of money and math, really.
It's pretty interesting.
Mm-hmm.
That's some good stuff, man. Oh my God, this is some good stuff. I'm telling you.
Yeah.
Listeners, listen. If you're not getting this, I don't know what to tell you. Like this right here is the cream of the crop. It gets no better. It gets no better than this. I mean, breaking down, W-2 money from real estate money. I mean, taxes, when to save, when not to save, when to invest, how to invest, when you move your money. I mean, you have to listen to this episode about 4 times. like listen to the episode.
Hopefully not.
4 times at least minimum. Rewind back. What you heard. Make sure you heard it right. Write it down. Then contact Ryan and ask him, Ryan, are you sure this is what you said? And Ryan gonna say absolutely. And help you out from there. So Ryan, man, look, it seems like there's a lot more to unpack here, and we will love to have you back to unpack more. So come on record. We like to get everybody on live on screen here. Tell us you're coming back.
I'm coming back whenever you want.
My God. All right. So with that being said, man, what does find your freedom mean to you?
I have a simple, very easy definition. At least for me, it's no one with my last name has to worry about money. That's my definition of freedom. It's not like when you pass away that you could take it on a 18-wheeler with you when you're gone, or they print they take a snapshot of your bank account and they put it on your tombstone. Maya Angelou said, people will forget the things you said, they'll forget the things you do, but they'll never forget the way you made them feel. And I want to make people feel like I was impactful and that I could help them. It's also about the time freedom. So actually last week I was in Arizona for an entire week at a business mastermind event, also playing some golf with some friends, and got to hang out with my wife. So I wouldn't be able to do that if I didn't have a business and a rental property portfolio that was making money for me without me having to do anything.
That's awesome.
Oh, that's super awesome. I love your definition. So Ryan, I know a lot of people are gonna ask how can they connect with you. So if you could share what's the best way to contact you.
Yeah, every social media channel, YouTube, Instagram, Facebook, Twitter. It should be my first name, last name, CPA. So Ryan Bakke CPA on all social media platforms. I also have one of the largest Facebook groups for real estate investors called Tax Strategies for Real Estate Investors with me, with Ryan Bakke CPA. If you send me a message, it's very likely that I'll respond back to, because I still respond to all my DMs at this point.
Awesome. Listen, man, once again, we're grateful for everything that you shared today, and grateful that you're going to come back and share some more. So we're coming to the ending of our show, and at this moment in time, we like to do the big boom session. So what we're going to do is I'm going to count to 3, 1, 2, 3, and after that, in a uniform manner, all of us will say boom as loud as we can. All right, you guys ready?
Mm-hmm.
Parker? All right, perfect. So giving the listeners opportunity to turn their radios down. All right, 1, 2, 3. Boom! Awesome. Check this out. We just had an amazing episode with Ryan. And look, if you don't go on Facebook and join his tax strategy group, I'm going to be honest with you, you are absolutely a fool, because it's super active. You ask any and every question in that group, and Ryan and other knowledgeable people are beaten down just to give you an answer, just to move forward. And also, and I'm being honest, listen to this episode multiple times, because there's a lot of things that was said here that can really change a lot of the things that you're currently doing with your current situation, and you don't want to miss that. All the knowledge is right here. Listen to it. All right. Also, make sure that you reach out to Ryan. Join his Facebook group, reach out to him on all social media channels. He's super active on it, and his reels are great. I have to sit there and say, so you're going to get just more knowledge and more information, as well. And we also need you to leave us an honest 5-star review. That's how we able to bring on more Ryans to the platform. And share this with all your friends, your family, your sister, your brother, your cousin, your uncle, your aunt. Share it with everyone. Share it with all your coworkers, the ones that you like and the ones that you don't like. Until the next episode of Find Your Freedom, we talk to you soon. Peace.
Bye, everyone.
Thanks for listening to Find Your Freedom. Be sure to subscribe wherever you listen to podcasts. While you're at it, please help us spread the word by leaving a rating and review and sharing the podcast with friends, family, and colleagues. Until next time, get out there and find your freedom.